Okay, Chair, we're now live on YouTube. In terms of apologies, I have not received any, no.
I've not received any. We welcome the public to this investment subcommittee meeting on the 27th of November 2020. Obviously, with the current situation, we're doing a live feed via Zoom. All membership is in attendance. We've had no apologies. So I thank you all for joining us. So if we go to item 2 on the agenda, notification of request for members of the public to address the meeting.
None received, Chair.
None received. Thank you, Paul. Item number 3, declaration of interests, if any.
No.
No. Okay, thank you very much. Any councillor who declares such an interest must remove himself for the whole of the item if you then feel like you have a declaration of interest to be raised. Chairman's announcements. There are no chairman's announcements this morning. Item 5, the minutes of the investment subcommittee of the meeting held in public on the 18th of September 2020. Are we all in agreement that they're approved?
Aye. Agreed.
Thank you. So they're approved. Item 6, the quarterly performance report for the period of ending the 30th of September 2020 in public. That was presented by Peter Gent. Are we approved?
Yeah, agreed.
Yeah,
agreed. Thank you very much. Item 7, the responsible investment update in the public pack, presented by Richard Perry. Oh, actually, that's today, isn't it? Sorry.
Yeah. Hello, Mr. Chairman. Richard, unfortunately, the active listed subgroup is occurring at the same time as this meeting. I'm nominally the chair of that group, but obviously with it clashes of this meeting, I'm here, and Rich is stepping in for me on the active listed subgroup. So you've got me for the reports today.
No, that's fine.
We're going to, because there's a lot of presentations from Mercer's on risk management and private equity with one of your private equity partners. We're going to take the reports as read and answer questions. We think that would be the best bet here. Now, on this particular one, we do have Mercer's who have a pack, and perhaps it would be worth them just talking to the pack, and then if there's any questions on the report, we answer it then.
That's fine. Is the committee in agreement with that proposal?
Yeah.
Yes.
Yes.
That's fine. Thanks very much, then, Paul.
Yeah.
Thank you. So, Peter, would you?
Yeah, I do. Are we happy with the responsible investment update?
Well, if you we're just saying if you'd just like to do a brief cover of it. I'm not going to talk to the report. But if you'd like to do a brief cover of your key thoughts on it and what we're going to do, and then we'll come back to the report and answer questions on that.
Paul, sorry, I got a bit confused. I think you showed the risk training document.
Yeah, we don't have an RI paper.
Oh, sorry, apologies. No, I'm looking
in.
at the wrong pack. I'm looking at the wrong pack. You can tell I'm missing Richard. I apologise for that. Yeah,
we're having a great day today, aren't we?
Yeah, it's Friday. It's the end of the month, isn't it?
It is. Apologies. I saw. No, I know what I was doing. Apologies. I just saw a thing and I got lost. Apologies. Yeah, no. So, any questions on the report itself on responsible investment? I think we have done a lot of training on this. I think you are all up to date anyway, and this is just going to progress it.
Yeah.
I agree.
Okay, that's fine.
Sorry, I'm jumping ahead of the reports, aren't I?
You are.
Just a little, so we can cover that one off later on in the meeting. If we move then to item 8, which is the risk management report. Again, I take it, Paul, that's your presentation.
Yeah, that is it. Yep. So basically, again, on this one, I think we do need just to ask Peter to say a few words, and perhaps invite Mark as the independent to make some comments, as well as the two advisors, key advisors to the committee. So Peter, if you'd like to commence.
Yeah, I'll go through our paper. I think that probably works the best, and then we can have kind of an open discussion here. So, this is a theme that we've been talking about for a little while, and I guess our job in terms of running this portfolio and investing is a lot about risk management. So we talk about risk in the round when we think about all sorts of investments. What we want to think about here is some particular risks and the impact they have on the fund, what we might want to do, if anything, to control them, and some of the techniques that we can use. We've had some training from a couple of parties in the past at Information Days. We discussed it back in February to come back with a more updated proposal. So that's what we're doing here. Like I say, I'm going to go through the deck slide by slide. Let me know if any of this stuff is obvious. Equally, let me know if you want more explanation, ask questions, etc., etc. So with that in mind, just on the introduction, and hopefully you can see these slides here, but page 54 of the pack, if you can't, just what we're going to look at here, aligned to what I just said, really. So, what are the key financial risks faced by the fund? What's happened in markets, because we're going to have a look at equity risk in particular, because that's one of the main risks in the fund. It's a rewarded risk. We expect to get paid for it. We like equities. We like the return that they deliver us. But as we saw back in March, we can see some pretty significant price volatility being invested in equities if they are to sell off for various reasons. Ways of dealing with that risk and where we might want to take it next. One thing I would say is we can talk about whether some of these techniques are attractive at the moment. I would always say when we look at anything, in a way, it's almost better to look at something that's, from a long-term strategic point of view, it's good to look at things that you think might be attractive in the future rather than necessarily are kind of attractive right now, because we need to go through that governance training process. And obviously we can't just implement something here and now. So even if we don't, even if we're not clamoring to do something right now, it might be something that there is a trigger point in the future that we might want to look at as a possible technique. And having done this training in the past and considered all the nuances and options and things like that, just makes that path to putting it in the portfolio a lot smoother. So moving on to page 55 of the pack, page 3 of our deck. So what are the fundamental risks faced by the fund, or the main risk? So like I said, we've got equity risk here. We've got a pretty chunky allocation to equities. I've said this in the past, we see listed equities as being the real engine of the portfolio. It really helps deliver the growth. Over the long term, we expect equities to be the highest returning asset class, or certainly one of the highest returning asset classes. So it does a really good job for us. But like I say, and we'll look at some of the numbers on the next page, we all know that there is quite a lot of risk there. The prices move around quite a lot. There's a lot of volatility in there. Now, arguably, and it is a very good argument, as an open long-term investor with a strong backing, then you can absolutely take on some of that volatility risk because you expect to be paid for it. It's a rewarded risk. So we're comfortable taking it to a point. What we don't want to do is be over reliant on that risk, such that if we get another March event or something similar where markets really sell off and probably stay low, because a lot of markets have recovered post-COVID, what we don't want is to get to an actuarial valuation date and we have a big funding deficit that has to be made up. And the only way that can be made up is through through additional contributions from employers. What we want to do here is make sure we have sufficient growth, but we're helping to control that risk to make sure that the contribution rates paid by all employers of the fund remains affordable and probably crucially stable as well for cash flow forecasting. There are other mechanisms to do that we can look at. This is just one part of the puzzle that helps control some of that volatility risk. The other one there quickly, and sorry, equity is what we'll focus on for the rest of the deck, but I think it's useful to talk about some of the others. So currency, so we invest overseas. We obviously pay our pensions in sterling. That currency differential presents some risk to us. So if we're generating returns in US dollar, then we obviously have to convert those investments back to sterling if we want to then use them to pay out pensions. We have done some work around this currency risk back in 2019 or late 2018, because sterling was rather low as we were going through the Brexit process and sold off material after the 2016 referendum. That was actually helpful for the fund because it actually boosted the value of those overseas assets when we look at them on a pound sterling basis. So we wanted to lock in some of those gains, and we did that, and that's helped smooth out some of the currency volatility that we've seen. Sterling has weakened a little bit more since then, but it has been quite a volatile ride. It weakens quite significantly over the COVID period, and then it's been recovering since, but we've taken some of that risk out. And what that means is fundamentally we're broadly at a neutral position on it, so that we don't have to worry so much about it. We don't have to worry so much about movements in currency, and this comes back to the equity piece as well. What it allows us to do is focus our attention on other areas given the governance budget that we have in place. It just helps control that risk so we can spend time looking at other areas. Inflation. Obviously the value of our members' pensions are linked to inflation. They increase with CPI over time, so that if the expectation of inflation increases, then the expected value of those pensions also increase. Now, if the portfolio doesn't keep up with that increase in inflation, then that's the risk that we run. So we want to be making sure that we're keeping up with inflation. I'll talk about inflation a little bit more when we get to the Part 2 monitoring report, because kind of the reported levels of inflation through CPI and RPI have been rather low recently. Now, there's an argument that inflation has been there, it just in different places. You know, we look at house prices, for example, and other assets have been really rising. So there has been inflation there, just not in how we measure inflation, which is how the value of the benefits is linked. But if we see a pickup in that inflation rate, then that could come as a bit of a shock to us, having come from quite a low base of that measured inflation. We look at some of this inflation linkage. So specifically some of the infrastructure assets we put in place, some of the alternatives, we want to have explicit linkage to inflation to control that risk. In other parts of the portfolio, we want to make sure that we're beating that rate of inflation to make sure that we're keeping up with the change in pace in those value of those benefits. Cash flow, the final one there. So that's just making sure we've got enough liquidity in the fund. Particularly important if we get to the stage where we're cash flow negative, which I think will happen and will come around in the next few years. As the fund matures, we get more pensioners coming through, so the amount of pensions we're paying out gets higher than the cash we're getting in from contributions. That's when we become cash flow negative. The issue there is that if we're not generating cash, then we have to sell assets to be able to meet that shortfall, which is a perfectly valid thing to do, but you run a risk there that if the market sells off, then we have to sell assets at a given point in time to be able to fund that cash flow. And that obviously represents a risk if the markets are low, that we're crystallizing a fall there, and we care slightly more about the volatility risk that I talked about earlier. So that's a slightly longer term one.
Can I just come in there,
we
Peter?
might want to look at.
Just coming on the cash flow. One of the interesting things we had in March, April was that cash flow issue hit us. We had a very large infrastructure fund that we needed to find the cash for, and obviously we had issues because, as you know, dividends stopped and cash flows were very tight. Now we got round that. We had pre-planned it, but that did, for the first time in the time I've been looking at this fund, it did give us a bit of a wake-up call. So yeah, certainly we will be considering that as a risk going forward, whether we do it through a vehicle like this or we'd do another vehicle. But yes, that was the first time that hit us.
Yeah, and it's probably worth just pointing out here, well, we're not, at this stage, we're not necessarily thinking about ways of controlling it, or vehicles, or putting things in the portfolio. This is just highlighting what the risks are. And like I say, when I was talking about inflation and talking about currency, we have made moves to control some of these risks in other areas. What we want to make sure is we're always coming back to these things and saying, is there anything more that we can do, whether that's specifically through some investment that we want to put in the portfolio, or through tweaking some of the other things there, or it might be a policy piece as well. So the cash flow bit is all about budgeting and policy and making sure we've got a robust thing in place so that we can meet cash calls as they come through.
Peter, just before you go on, so you have historically also included liability risk control as part of your framework. Is there a reason it's not here? Is it just to avoid extra complication?
Yeah, a little bit, Mark. I mean, it's kind of wrapped up in the inflation risk. When we used to talk about liability risk, we talked about interest rates and inflation risk. Now that's arguably fallen away slightly because of the way that the actuary values the liabilities now, has less linkage to interest rates. It still has some, and it's still important, but where we're focusing here is more on the asset risk particularly, and the inflation risk, which, if we think about inflation risk, is actually real yield risk, which is getting is getting kind of a bit actuarial and techy potentially. It's kind of one of the same thing. We've just called it inflation risk.
Excellent, thank you.
Okay, so like I say, for the rest of the paper, we will focus on the equity risk, because it is one of the main risk factors in the fund, just given how much equity we run. So the chart here is...
Peter, sorry, can I just, a quick one before we go too far on? The thing about currency, when you're saying about the low sterling price, so I thought we was going to have some questions after that first slide, but where you said that we get the low sterling price level, and if we have to transfer it back to sterling to obviously pay pensions and pay benefits out, isn't that sort of like a two-way street? It's either we've bought the, say, when you said about the dollar, so we bought the dollar at a particular level with sterling. Does it not sort of almost even itself out? Because sometimes you get a higher exchange and sometimes you get a lower one, and if you buy high and you sell low, you make more profit, or does that not? I mean, I take it you take that in your consideration.
Yeah, and look, we did this because sterling, the market really sold off sterling, so we wanted to lock some in. There are good arguments to have that overseas currency exposure, but we don't see it as a rewarded risk. So it's not something we're expecting to be paid for, whereas taking equity risk is. So arguably, if it's not rewarded, i.e. you don't get paid for taking it, then you shouldn't take it. So you'll want to remove it. Now, like I say, there are good reasons to take some of it. And does it even out? It arguably, potentially, yes, unless you get big structural changes. The issue that we have is when we report, and if we want to bring some assets back to sterling, then we are exposed, and if we get kind of blips in the market or shorter term structural changes, then we are exposed to that currency risk differential. So it's not something that we just want to say let's get rid of and let's spend lots of time on, but it's something we want to acknowledge is there and control it.
Okay.
So let's have a look at equity markets. So what we've done here is we've said, if you've got £100 invested in each region of the large equity markets of the world at the start of the year, where are we now? And obviously, we all know this. March, we saw this massive sell-off in markets. We talked about it last time in terms of being one of the fastest, sharpest sell-offs in markets ever. COVID's economic impact is ongoing. We've seen quite a remarkable rise in some markets and quite a dislocation in markets. So we can see here the US market in the dark blue at the top has really, really recovered strongly to the point where it's up 10% on the year, give or take. A lot of that is driven by the tech stocks that are in there and how they've really driven that rally back, particularly the big five tech stocks that have helped that come back. The Asian market as well, so the Japanese market here and the wider Asian market has been similar, really recovered back to where it was. Because they were frankly better at controlling the virus, because they've been through some of these public health issues in the past, whereas Europe hasn't, and Europe has really struggled, particularly the UK, which is rather low Some of that is structural in terms of how that UK index is made up. There's a lot of oil and gas in there that's been, obviously the price of oil really sold off, which has affected them. There's a lot of financial companies in there as well that have really struggled as interest rates have come down. A lot of cyclical companies in there that have struggled, but the European markets have tended to be quite low. But what we saw because of our exposure to equity risk, then this really harmed the funding level. And when we talk about funding level, if it is that percentage ratio of assets to expected liabilities, so what we expect to pay out in the future, kind of one of the metrics of assessing the financial health of the fund. It's not the only one, but it is, it's a metric we want to look at. And we saw a really big fall off in that funding level of over 10% because of that fall in markets. Now, the risk here, all is going back in the right direction, but the risk here is that markets then stay low and that funding level is impaired for longer, which has more of a contribution strain. So that's the risk.
Peter, can I just ask, the incoming president in America doesn't have such a high valuing of shares and that type of thing, and it's suggested that shares could actually go down significantly in America. Do you think that will have an impact on this?
Potentially, it's what we talked about last time. We kind of said Trump is good for markets because he deregulates and detaxes. Now, we'd expect Biden to go in the opposite direction and put more regulation and increase taxing. I think a lot of his ability to do that, and I'll talk about this in a minute, is what happens in the Senate. But markets actually were interesting. So when it appeared that Biden was going to win the election, or when he looked like he was nailed on in the run-up, markets carried on rising because they were expecting him. The expectation is that he'll come in with a really loose fiscal policy and use all that taxation to spend money in the economy and boost jobs, which boost markets. Now, the market was also saying the same thing when it thought Trump was going to win because of this regulation and tax base. It seems to be going up. It seems to be trying to find good news in a lot of areas. Whether that points to, too much confidence in the market and it could sell off again, I don't know. But fundamentally, you would expect Biden to be less favorable to markets and put some risk on that US tech piece, and particularly in terms of antitrust, so competition laws. We've seen a few things in Europe on Google and some of the big tech firms coming through. Whether they put the brakes on those tech firms that have really, really driven this rise, I think that is a risk that we could see. Other risks that we could see is, I think the COVID situation's looking better and the market's really rallied, and it's rallied post this chart, because we've only gone up to kind of mid-October on this one, but we saw the vaccine news come through and the market's really shot up on the news of that, and we've kind of seen them tail off a little bit.
It actually says the end of August, so is it later than that?
Oh, sorry, yeah, end of August. It's just when we produced the paper, but what we've seen here is kind of flat over September and then really increased when we got that vaccine news coming through, and kind of came back a little bit as some of the kind of regulatory processes have become a bit more apparent to the market and the timescales to get that vaccine out. I think fundamentally, so those small volatility pieces are something we can absolutely absorb because we know the risks are in there. What we want to do is see if there are any apparent dangers in there and whether we want to do something about it and whether we're comfortable with the level of kind of broad equity risk that we're taking.
Just on the Biden situation, I saw, Peter, figures. Most people estimate about a 10%, 11% fall in S&P 500 earnings if he was to be able to carry out some of the things. So that's pretty much in the market anyway. But I think the point you make is absolutely excellent. It really depends on who controls the Senate ultimately. And we'll know that in January, won't we?
Yeah, I think it's the 5th of January when Georgia or someone, I can't remember, votes.
Georgia runoff.
Yeah, it's a real, the president is not all powerful as they might want to be. They do rely on the Senate, and it's a coin toss at the moment. If you get a Republican Senate and a Democratic president, which is what Obama had, then you really struggle to get policy through, particularly kind of further along in his tenure when the kind of goodwill of the first 100 days has kind of gone away. So I think that's a real key piece, and you might see markets move a little bit off the back of that, because I would, what he'll want to put his spin on things in terms of that regulation and the taxation, but what he might struggle to do is implement the fiscal spending policies that he wants, because the Senate won't give him the money.
Absolutely. Yeah.
So that's a risk outcome. Similarly, we've got Brexit on the horizon. Again, we don't know what Brexit's going to look like. It feels slightly more positive, and the UK market's come back a bit, and sterling has gone up off the back of some positive Brexit mumblings that they're kind of getting on and negotiating. But again, that's a risk that is there. So I guess strategically, moving on in terms of why does this matter? And I talked about kind of being willing to take risk because we think we get paid for it. Why does this matter? What we've shown here is the progression of this funding level. So that ratio of assets to liabilities over the last year or so. So, we came into the start of the year at 98% funded. So, for every pound of pensions we're expecting to pay out in the future, we've got 98p in the pot, so a really strong position, and as close as makes no difference to being fully funded. We saw a really big drop because of COVID. We've seen that increase. That's up to 88% there at the end of June. The end of September numbers that came through after we issued this report is up to kind of 93%, I think 92, 93%, something like that. It's probably creeped up slightly further since to mid 90s, so a really strong recovery. But what we're talking about here is going forward, we've seen this volatility in the funding level, and I've talked about the impact that could have on contributions. It's this uncertain range of outcomes that we could get because we're taking some of these risks, and we need to make sure that we're understanding what that range of outcomes are and whether we want to narrow them or if we're comfortable with the range that we can get. And arguably from a standpoint of what you're looking at here is to get rid of some of these bad events, then you have to give up some of these really good events to narrow that funnel. Now, your kind of skew of what you're worried about changes as your financial health improves. So when you're close to 100%, I would argue that you're more worried about losing than you are about not winning. So when you're well funded, you're more comfortable to chop off some of these tail events and give up some of these events because you just don't need them, because all you need to do is carry on delivering the level of growth that you want. You want to perform as well as you can, but you're not necessarily willing to take the same level of risk because you just don't need to generate that excess return to grow that funding level because you're already there. You're just in a maintenance state. And what you're more worried about is an event like this that sets you back, and then you have to take the risk again to grow back again up to 100%.
Peter, can I just raise a point, which I'm sure you're going to come on to, but this is a good time to do it, I think. So when we were sitting close to 100% funding level, that is 100% funding level at the current discount rate.
Yeah.
So there are two aspects to this, in the sense that the discount rate will change depending on how much equity risk you're running. But at the same time, as Peter says, you want to avoid the worst outcomes. But it's important to realize that 100% isn't there forever, because 100% does absolutely still need you to be generating your discount rate of return into the future. Is that how you describe it, Peter?
100%. So we still need to take, even when we're 100% funded, we can't go to a lockdown. I shouldn't use the word lockdown. We shouldn't go to a low risk position to reduce that risk, because we still need to take it to generate the expected return that the actuary puts on the valuation. So it's very much a balance, and it is a bit of an art rather than a science. It's well thought through, but there's no right answer here. We just need to make sure that we understand what risk is, how it fits together, and then we need to understand what the impact of controlling some of that risk is and whether we want to do it or not, and taking a pragmatic approach to it. So what do we mean in terms of these range of outcomes? So like I say, we've got a chunky allocation to listed equity, 1.5 billion in the portfolio, just over half our total portfolio. What we've done here is done some really simple stress testing and said, if markets move, if equity markets move, and this is talking about all markets moving over a period of time at the same level, which is obviously never happens, but it just helps put it into context. If markets move, what impact does that have on our deficit and our funding level? So we can look at the top here. This is where, you know, our current position. So obviously as markets increase, and this is from the kind of mid 80s point that we had in the middle of the year rather than the updated mid 90s that we have now. So I think it was from 88%. So, you know, if we see a really big jump up in markets, then it gets us to over 100% funded, which is where we want to be. Equally, if we get a really big fall in markets, then it takes us down to 75%, which is quite a material fall from the 100% that we found ourselves in at the start of the year. Now, given markets have sold off, some of them have recovered, some of them haven't, then you'd probably put more weighting probability on markets rising rather than falling at a material level, but the risk is still there. So you're probably looking at, you know, what's my absolute risk? Well, it might be a kind of 10, 15% fall, but still it takes you down to around 80% funded. Now, if we protect all that equity, and I'll talk about what protection of equity is in a bit and the details of it, but if we reduce the risk in that equity over all of it, then we really narrow the range of outcomes that we can get. And what that kind of means in practice is that if you get that big fall in markets, instead of going down to 74%, then we only go down to 83%. But on the converse, if markets really rally, because we have to take off some of those really good, favorable topside events to be able to protect some of the bad events, then we only grow back up to 92%. So we're not capturing necessarily enough of the market rise to get us back to where we need to be, which is potentially as unfavorable as, you know, getting this fall. It's not, we're constraining the portfolio probably a bit too much unless we really think that the market's going to fall off. Okay. So just from a strategic point of view, and if you're going into this without any market background and you think there's an equal probability of ups and downs, then you wouldn't probably want to go to this point because you're just constraining yourself a bit too much. But if we take kind of a middle view, so if we just do some of it, we take some of the risk off half the portfolio, so this 20% passive we talked about here, then it takes the edge off some of the falls, but gives us scope to grow back to that 100% if markets really rise. So that nice balance, and just squeezes our range of outcomes a little bit and takes the really bad edge off it, but still gives us that scope to grow. Now, like I said earlier, we're not at 88% anymore, we're closer to 95%. So we can shift all these numbers to the right a little bit, which maybe makes doing some of this slightly more attractive, because we will have that scope to go back over 100% if markets rise.
Peter, just so I understand what's happening here. So this is so replicating an equity market fall of say 20, 30%, something like that.
Yeah.
But it's, is there any, so I suppose what I'm trying to ask is this not a Monte Carlo simulation?
No.
No, right.
It's a really,
sorry.
It's a really simple stress test to kind of give an order of magnitude. And it obviously comes with a lot of caveats, etc.
No, absolutely. No, I mean, it's good to do it in a clear way, but I think I just need to get in my head. So for instance, you don't have the offsetting, for instance, I know you talk about correlations going to one, but sometimes in market shocks, some of the lower risk assets like gilts or treasuries or something would actually go up. So you would have some. Okay,
yeah, you'd have that second order hedging, and you know, we could have done those numbers, but and it arguably gives it more context, arguably makes it slightly more confusing because you're getting other things coming through, and it relies on assumptions that don't necessarily play out, and arguably you could get a sell-off in property and private equity and things like that if you get a really bad market event. So particularly when you get in these extreme events and these tails, it's when those assumptions really start to break down.
Yeah.
And you can get the messaging can get lost slightly. So yeah, it's a really simple. We shouldn't put we wouldn't want to put an awful lot of weight in these in terms of setting a level, but it just helps give an indication of the level of risk that we're potentially running.
I mean, one thing I found quite interesting, and perhaps you could put a bit of flavour around this, but my eye was caught by the 20% fall, which is something that we've seen quite a few times. The actual funding level difference, particularly if we're talking just about protecting the passive, is sort of it's sort of 78 to 80. It's not a big change, is it? And I was a little bit surprised at that.
Yeah, it's because we're still participating in the first 10% because of the way this hedge is structured that we'll talk about in a little bit.
Because of the Yeah, fine. Thank you. That's great. Yeah, makes sense.
So that's kind of that is equity risk. That's what we're facing, and like I say, we want to balance it. So how do we manage this thing, and what are our options to do something about it? And the first option is to do nothing about it, which is a perfectly valid option to take. Like I said at the start, equity risk is rewarded. We get paid for taking it. We've seen markets grow a lot over the last 10 years for a variety of reasons. So we might be comfortable taking that level of risk. We've had a look, we might have understood it, what level we're taking, and we think we're fine with that, especially against the backdrop of where markets have been over the last year, what our outlook is over the next 6 months are or so. Okay, so that's number one, do nothing, but it is an active decision to do nothing rather than a passive decision. Reduce exposure. So this is about moving from a risky asset to an off-risk asset. So that's moving from equities to bonds effectively, which we might want to do if we're really, really well funded and we can afford to do it, because we don't need to generate the same level of return as Mark talked to earlier. I would suggest that's not probably the right place to go at the moment. We still want the equities in there. We're comfortable with our bond allocation because we looked at that kind of 18 months ago as part of the strategy review, but we could just sell some equity, buy some off-risk assets and kind of lock in some of those gains. We can diversify, and this is where we'll kind of take the conversation next. We can diversify, and we've done some good diversification. What we go and do is we say, well, we want growth in the portfolio, but we don't want it all coming from listed equities because that's a concentrated risk. Sure, we diversify through our equities between different companies, between different countries, between different sectors. But when you get a market fall, then it all gets wrapped up and equities sell off. So we want to look for some other return drivers. And we've done that through private equity. We've done that through infrastructure. We do that through property. So we're delivering the right level of return, but we're taking the risk in different areas. Okay. And then we can protect equity. And this is the conversations that we had last time in terms of equity protection. What does that give us? It gives us some of the things here that I've already talked about in terms of reducing volatility, stabilizing contributions. I think what it really does do, and we can look at why this is in a little bit, we can bespoke it, we can tailor it to our exact needs. And there's also a contractual element to this as well. When we look at these kink lines that you will broadly be familiar with, they are contractual and they don't rely on those correlations that Mark talked about earlier. They don't rely on the assumptions that when equity markets fall off, other assets will do well to offset that, which is true in normal markets, but less true when you get stressed markets and everything falls off.
Peter, could I just ask you a question around the stabilization point?
Yeah.
So obviously the valuation or the methodology used by our actuary is to model 5,000 economic scenarios, and we have a whole load of employers who are on a very long-term time horizon. So like the local authorities, for example, which will be over around 20 years. And in that modelling, what the actuary said was the outcome that happened, that big drop off was actually accounted for in those scenarios. Is it within the funnel of expected scenarios? So I guess my question really is this stabilization more around those employers who are, say, a couple of years away from exit? There's a real time sensitivity as opposed to more the ones who are longer term.
Yeah, potentially. I mean, we can talk about what we would do with some of those employers. We want to manage risk for those employers. I mean, you could take them to a very low risk part of the portfolio, notionally, to do that, or we could holistically manage risk for some of those employers within the equity part as well, which this does. What I would say is, the stabilization methodology the actuary uses is a perfectly valid thing to do because you are a very long-term investor. Where it may struggle is if you get kind of a structural fall in markets and they fall and go low. I'd imagine some of that stabilization relies on volatility and things coming back to kind of a normal and expected growth rate. If you get a big change in the world, and things stay lower for longer, that's when you'll probably want other things to help support that stabilization method. And look, in risk management, in any sort of investing, in frankly any kind of way of running things, there's no silver bullet to manage uncertainty and the future. What we probably want to do is use a range of methods, because different methods will work in different environments to make sure the whole thing fits together to manage that overall outcome. So we're not saying kind of this protected equity is, you know, the answer. We want to use a range of things like diversification, like stabilization methodologies, and consider them all and how they can interact with each other to make sure that we're more confident of getting the outcome that we want.
I think, can I just add to that? Because I think Mark's made a really, really good point there, because it was the thing that's slightly at the back of my mind, which so I've attended a lot of times where we've done the sort of Monte Carlo type modeling, which is what Mark's just described, and we've gone through all this. And my understanding normally was that really what you're looking to do is create an asset structure that gives you a probability of being fully funded over a time period, and that where you flex is you flex essentially what you're willing to do in terms of, you know, a two-thirds certainty to be able to hit 100%, and go through all these different scenarios. And that is, I think, that's how I've seen things done, and it sort of ends, you end up going down more the diversification route, etc. Is that something you think can be improved upon? Because I think Mark really has hit the nail on the head there, is that these are within the cones, if you saw what I mean, even these events, for a long-term investor.
Yeah, and I guess what we're looking to do is probably shrink that cone, shrink that range of outcomes, because we're in a stronger position, and we don't quite need the upsides because we're worried about the downside. So it still matters how big your funnel is, and what we're doing is looking to shrink the funnel. That you can do all this in. It's a good way of doing things, Monte Carlo, but you know it's not the answer. It still comes back to relying on the assumptions that you put.
Wasn't the point was that we were more worried about the downside than the up?
Yeah.
And that's why you want to shrink the funnel, because it's not an equal payoff, as far as we're concerned.
Well, I guess what we want to do, and it comes, you know, if March was in the funnel, are we comfortable with that market event being in our funnel, or do we want to shrink our funnel so that becomes kind of abnormal? If that makes sense, that's beyond the range, so that when we go through that, the impact is less.
Yeah, I guess it depends on how much protection you put in place, of course, because we went below the protection level. If it was -30, you know, during that event, and there'll be even lower outcomes built into that modelling. I think my point was actually that there is you know, stabilisation is great, having long-term funding. Sort of time horizons is fantastic, but there are a range of employers where actually it's much more shorter term. It's much more sensitivity to those big fluctuations, and so, you know, clearly something like this can help those types of employers. It's not a huge part of the fund, but there's quite a few of them.
And it's really important to them, obviously, and you know, it's as important as it's potentially a big shock to them. So yes. Yeah, absolutely. This is something you can use for them. Okay, so the next slide is, again, it comes back to why we want to take a range, of approaches. So what I've done here is, and again, I'm kind of taking the protected equity. I'll go into some detail about it in a little bit. I'm kind of aware we've discussed it, which is why I'm introducing it slightly later. So kind of comparing protected equity versus diversification. And I've done this in a fairly broad brush approach, because I've just said, well, you know, back a good few years ago, Baillie Gifford Diversified Growth Fund, which does what it says on the tin. It's a diversified pool of assets that it looks to deliver growth. It was put in as kind of a broad brush, diversified way of investing. We've moved on from that. We've started looking at individual asset classes, so infrastructure, private equity, things like that, to build our own diversified growth fund. And we've talked about that in the past. But I've just used Baillie Gifford here as a diversified growth versus protected equity, and kind of compared the two approaches and when some work and when some don't. And, you know, the experience of the DGF was, these correlations really spiked in the big market event in March. What do I mean by that? It's that assumption that there's offsetting between different assets. That offsetting broke down to a certain degree, and most things fell. So that what we saw is some, reasonable losses on the diversified approach, 13.7 versus the equity market of 15.7. So it didn't give tons of that protection. Now it did there's no slight on Baillie Gifford in terms of how they run the fund. It's just when those correlations break down and everything sells off. Equally, when the market rose, it didn't participate in all the upside as well. So like I say, when I said on the previous slide, there's no silver bullet here. There's no one right answer in a way of managing this risk. And the diversified approach can really break down when you get those big stress events. There are also actually cost implications. So there's a lot of people say that equity protection is expensive, and that comes through in terms of opportunity costs. And I'll talk about that in a little bit. But in terms of kind of management costs, it's quite a lot lower than a diversified approach. And I think the point here is aligned to my previous comments. It's something we want to look at in terms of taking a range of approaches, understanding how they can fit together so that we get the right overall outcome for the fund. There's no one right way of doing things. So we want to take a range of, when we look back on this slide, in terms of what do we want to do? Well, we want to do all of these things just to different degrees. To an extent, we want to do nothing because we still want a material level of equity in the portfolio to deliver that return. We do actually want to reduce some exposure because we do hold some index-linked gilts to help with some of that liability control and some of that tail risk management. And because we are in a decent position, we've already done quite a lot of diversification. That's a good thing to do. We don't do the protection, so that's kind of the final piece that we're looking at here to say, is that something we want to add into the kind of strategic toolkit to be able to use at some point in the future. So the next slide is where I'll start really kind of going into what protected equity is and how you might, if you wanted to, go around structuring it in terms of the things you need to consider. Before I get there, I'll just pause and see if there are any questions, I guess, on sort of the fundamentals of what I've talked through in the first 9 slides.
We'll open it up to the committee to ask any questions they feel appropriate or just like clarification on.
Yeah, well, I wonder if, Peter, you could, and it's going to be, I don't know how much you can say, but one of the things the committee may or may not know is that we've got a real live example of this in operation with our sister fund at Cambridge, who not only have a type of technique similar to what you can describe, but also lived through the perfect storm of the COVID sell-off at the end of March. So I wonder if you could, if you can, without possibly betraying any confidence, actually give us some sort of insights to how that's going, because it would be a really direct illustration of this in actual real life operation.
Yes, and what it so let's look at the shape, because this is what they put in place. So yeah, so that fund put in place a shape like this, and I'll talk you through the shape. So protected falls in the market between 10 and 30%. So what that did when COVID hit and the markets went down here is the structure did generate on the balance sheet quite a lot of positive value and really helped take the edge off that market fall. Now, since then, the market has risen. They left that in place. The market has risen back up to kind of around here on an average level. So they've given those kind of gains back, and they sit back on the equity line. But what it did fundamentally was meant that they could sit there and the market was falling and be less concerned about their participation in that fall. And they didn't mind if it grew back again, because it meant they were back on target. And I think this comes back to some of the fundamentals of what we're looking at here in terms of what do we expect these kind of structures to do? Do we expect them to generate a positive value over time? Well, no, not really, because we want the markets to rise and we want to benefit from those rises in markets. What we want them to do is secure ourselves against a bad event, so that we don't have to scrabble around and be concerned about the impact that it's having, because we know what's going on. And particularly if there's a specific timing event here in terms of where we think market pricing is at, and if there's risks on the horizon, or there's a period of time that we want to reduce some risk because we're coming up to a valuation, etc., when the contribution rates will be set. So I think that's the mindset that you need to get into when you think about these things. And look, I'm not going to say it doesn't come with certain challenges, and there are governance challenges around some of these structures that you'd need to think about in terms of what do you do in certain market environments to adjust this, because I said earlier, this is not an off-the-shelf product that you go and buy per se. It's something that you structure and tailor to your individual needs, which is great.
Would it be fair to say that if you thought there might be a long-term bear market, well, that structure actually does remain quite attractive? Yeah, it does. And if you're worried about a period of time, it's quite attractive as well. I mean, okay, it's bounced back, and think this, but I mean, it's entirely possible we have another massive dip and it doesn't bounce back, isn't it? Yeah, and what we're looking to do here is not necessarily be opportunistic and say, well, it's kind of gone down here and let's take it off and put something else on. We can have those considerations. What we're looking to do is just protect ourselves from really bad events and narrow that funnel. So to Mark's point, what did that do on that fund and the other funds that we work with that have these structures in place? It should have given them confidence that they were being protected from these falls in markets. And if that were to continue, and it could well have done, when we were sat here in March and the market was down here, did we think it was going to be back up here by this time next year? I don't think we probably did, but it gives them comfort that they're not participating in falls.
I mean, if I may, I'll just come in there. Obviously, that particular arrangement is still in place till around May. And we are, as a team, still picking up the learning points from that. So, it is as has been described, but we're still considering, we're still looking at that, still evaluating it. So I think there is saying those points.
Yeah, I think there's one important point, and I will talk in generalities because it is obviously we are in public session here, and the general point is that with these contracts. If you exit early, you don't get the full value of, if you like, the position where you are at that present time. You have to wait for the contract to go through to its end to get the full value of the fall. So that was and so if it had happened later during the contract life, then there might have been a different outcome in terms of wanting to exit. But that's something which I think we've learned as part of this process. That you do need to factor in. But as you say, that was a strategic play. We're talking about a strategic play here, and we're not trying to be tactical and make money out of this contract.
Yeah, and just as a final comment, if you actually look at the recommendations, we do look at some of the learning points we're picking up. But yes, the most important thing is picking up perhaps some of the obvious stress points, like covering a valuation cycle, a period where evaluation is looked at. You might want to put a protection in there, or the other questions: do you want blanket protection? These are all things that need to be considered and evaluated. This is still early days.
Yeah. So you've seen this kind of this thought piece before, but I'll just run through it very quickly about what protected equity is. So if we're invested in the passive equity market, we just go and buy the index, which we do part of our portfolio. We know what the outcome is going to be for that portfolio based on what the market return does. We don't know what the market's going to do. So if we're completely agnostic about the market, we don't know if it's going to go up 10%, down 10%. Let's leave that for later. But we obviously know that we're just invested in the market. If the market goes up 10%, then we get 10% return. So we get this dotted line here for being invested in the equity market based on what the equity market does. Fairly straightforward, I would hope. What we want to do is say, well, we don't like these sorts of events. We want to change what our participation is in the equity market based on that event. What we want to do is change this 45-degree line and change our portfolio return for a range of different market events. We want to draw some kink lines effectively. Now, the most attractive kink line, or one of the most attractive kink lines that you could possibly get, is that you don't participate in any downside and you get all the upside. That's kind of unachievable because you're getting something for nothing. You really do have to balance the level of protection you get, and you have to give something up somewhere to be able to pay for that protection. And I guess, you know, you kind of say, well, that maybe feels slightly uncomfortable. And we'll talk about that in a little bit. I guess if we look back at the other options, you know, when we diversify, arguably, and we saw that when the equity markets rose and these diversified growth funds lagged, then arguably we're giving something up there for the protection of correlation on the downside, because they tend to underperform in rising markets. So there's always a trade-off when we're looking to change our participation in the equity market. So what we do here is say, well, we want protection. And what we tend to do is say, well, we're comfortable with the first 10% fall in markets, because protecting the first 10, you know, protecting from zero is really expensive and unachievable. But we don't want to fall any more than 10%. We want to kink our line at 10% down here. So when the market's down 40%, we're only down 10%, but we want all the upside. Now, there is a clear cost to that. And the cost of doing that is that you have to give up 6.3% of your return. So the whole thing just moves down. So that if the market stays flat, then I end up minus 6.3%. If the market is up 10%, then I end up only up 3.7%. So I'm giving up, and strategically that doesn't work too well unless you take a really strong view, because I'm just giving up too much upside return and my portfolio will struggle to deliver the level of return that I need it to. Now, we can evolve this because you have a lot of the participants in the market who put these kind of shapes on kind of have to do so because of regulation. And I'm thinking particularly here about insurance companies who, if they want to put equities in their portfolio at a sort of very fundamental level, they have to put these protections in place so that regulators comfortable that people's money isn't at too much risk. Now, kind of what the regulator says to them is that you have to protect all the way down to zero. So, i.e., this contract is still worth quite a lot of money if every company in the world, or if we talk about just the UK, if every company in the UK is worth zero. And obviously you think about that in terms of what that means, and protection isn't worth an awful lot if every company in the UK is worth zero, because it's a fairly cataclysmic event. But because these institutions have to do this by regulation, it makes it quite expensive again to protect all the way down to zero. So what we might say is, well, we want, you know, we're not too worried about the market going all the way down to zero. In fact, what we want to protect is what we think a bad but normal fall in markets is. So if you look back over a period of a year, say, it's not very often that the market's down over 30% for a period of a year. So we're comfortable taking some reparticipation to make the overall structure cheaper. So we participate in the first 10% of falls, then we're protected, and then we reparticipate, and that really cuts the premium down to 3.8%. But it still has the issue here that if markets just rise in a normal fashion, then we just give up return. So what we're fundamentally trying to do is we're balancing the left-hand side of the graph, which is our protection that we want and we have to pay for somehow, and we pay for it by structuring something on the right-hand side of the graph when markets rise. Now here we're structuring it by just having a constant reduction in the level of return we get from the market. What we can do is put this cap in place so that we say we stay on the dotted line in between when markets rise to a normal level, and where this line is set is defined by the market at any given point in time, but we don't get anything after that. So that if, you know, we get a normal return in markets, then we get that. If the markets fall, then we get some protection. But if markets rise rapidly, then we give that return up because our return is capped at this sort of 10% level here. So if the market goes up 30%, then we still only get 10%. So when we talk about one of the kind of key risks and where this structure struggles, or this way of managing equity risk really struggles, is when markets really rise and we've given that up. Now that's I think that's what people refer to when they refer to this technique as being expensive. It's not expensive in terms of a kind of monetary cost we're paying out. It's expensive in terms of regret risk, because we could have got a 30% return saying we only got 10%. And that's something we kind of need to be aware of if you put these kind of techniques in place, that it will struggle under those market environments. But we can't have this left-hand side of the graph where we get meaningful protection from market falls without paying for it somehow on the right hand side of the graph. So I think that's a story that most of you have seen run through a couple of times, but I just think it's worth kind of a refresher about how these things are in place and how you come to putting it there. Now, in terms of kind of complexity, there are complexities on governance and monitoring and managing these things throughout the term, but I think that's a kind of different governance burdens and kind of a diversified approach and investing in different assets that does have its own complexities in terms of managing it, just different challenges. So it's, you know, there are quite a few things to think about, and I'll move on to kind of what you need to think about and what some of the funds do, having gone through this process in the next couple of slides. But I'll just pause there and take any questions.
Again, does anybody require any confirmation or questions that they'd like to raise? Clarifications?
I would just like to ask something about, and it's a memory I've got, which I will have to offline go and look up, but it's to do with the behavior of the way that market, because obviously what we're seeing here is a 45-degree line. But I seem to vaguely remember that if markets tend to move quite rapidly in relatively short periods of time, and if you eliminate the upside of participation during those relatively rare events, the actual return to equity over long periods of time is quite significantly lower. So I suppose what I'm asking, Peter, is, have I got a mismemory on that? Because I'm pretty certain that there is quite a lot of evidence that if you miss out on big market upward movements consistently, then over time you have quite a significantly lower overall equity return. Do you see the point I
think where it gets, I do, Mark. I think where it gets to is that you're quite, with these initial structures and these static structures, you're quite time dependent. So if the market's low when you put it on and high when you take on the day you take it off, then yeah, you can have, it can be unfavorable. Ideally, what you want to do is put one of these structures on incremental times to help smooth out some of that timing risk, so that you kind of get that, your exposure to the equity return is that normal distribution rather than the specific return that you get over that fixed period of time. Now that's a kind of step on. What we want to do is be cognizant of where markets are at before we implement, and monitor prior to expiry to see if there's any reason to take the structure off, because you can unwind them part way through, which is the kind of crux of the governance challenges and the complexity that actually comes through of running these kind of structures. It's not really understanding the fundamentals initially, because strategically I'm not going to say they're straightforward, but they're easy to rationalize through these charts with kink lines. It's living that experience in the governance process to go through that it takes time to get to grips with, as Paul's alluded to,
yeah.
And something that you really do need to experience to get there, and a lot of investors have, and they've got comfortable with the fact that if the market goes up then they don't get the return, and they're fine with that, because they don't feel like they need this excess return, because what they're worried about is participating here, because they have no control really over where this market line lands at the end of a given point in time.
Yeah, no, absolutely. I totally agree with that, and I think that's something the committee would absolutely need to be sort of on board with, and that's any decisions made in this area would have to be accompanied by a decision on the governance structure that sits with it, because I think that's equally important.
Yeah, I would agree. Yeah.
I suppose this would sit as a line item, wouldn't it? It's either positive or negative in terms of how the structure is performed. But then meanwhile, our active members will be hopefully generating greater returns on the upside and greater protection on the downside than the indexes these are protecting against.
Yes, indeed. I mean, it depends on the nature of your active managers, but this is just this is just obviously the market return, and it kind of it works. I mean, it works well if you just want to protect your market participation, which 20% of the portfolio is through the UBS mandate. It can also work for the active managers, because if we think about what an active manager return is, it's the market return, the beta, plus the active return that they give you, the alpha. So if we break those two things down, we can protect the market return, which arguably the manager has no control over. And we'll look at this when we look at the performance report. The UK active manager has performed rather well versus the UK market over the last 12 months, but the UK market has just structurally underperformed the global market. So that manager has no control over what the broad UK market does. It's just trying to beat that market. What we're looking to do is alter our participation in that market return. And then you would hope, if you did this over your active managers would continue to generate a return over that. Now, like I say, depending on the approach of the active manager, you're not always going to get a constant kind of increase, because some will perform better in rising markets, some will perform better in falling markets, particularly when you take into account the nuanced reasons for those rising and falling markets. Again, that's something we can look at when we get to the performance report.
And I think that will help inform this piece, really. I think when you look at the volatility of equity managers, actually determine where your funnel is quite a challenge.
Okay, is there any more questions? So Peter, if you'd like to carry on.
Yeah, and I've told, and obviously we always like to talk about risks, don't we? And these are kind of what can go wrong kind of risks. And we talked about the main one in terms of what regret risk is, and the major cost. If the market really goes up, we have to give something back. And we lose out on the, it's here's what you could have won kind of scenario if the market's really kind of rocketed by 20-30% and we've only got 10%. We've kind of met our strategic needs for the portfolio, but we could have got some more, which I guess is always the argument and the danger with perfect hindsight, but it is the real kind of risk of this technique. And you want to be able to manage it somehow, and that again comes back to some of the governance challenges that Mark just raised now. Something you want to think about. Some of the other risks there are kind of, I guess, so it's where we're getting into slightly more detail. It's kind of broadly swept up in the fact that these are through derivative contracts, which are well tested and liquid and well used through the market, but some investors have an aversion to them. What it does mean is there's no sort of initial capital backing them. What you have to do is they kind of move from a zero value effectively and move up and down, and if the position goes against you because the market's risen, then you have to post collateral there. You are also relying on a counterparty, so someone sat on the other side, so that if you make money out of the structure, they have to pay you the money. It's a one party paying through, so there's that kind of counterparty risk that they might not pay you back. The collateralization process, and we can talk about that in more detail if we want to look at this further, does a really rather good job of controlling a lot of that risk, and was well tested through the financial crisis. Anecdotally, where the biggest kind of counterparty risk comes through is if your counterparty, the other side of the trade, goes bust. You get all your kind of monetary value up to the day before, but then you don't have any protection on. And in that kind of market event, we think about 2008 and the Lehman's collapse, you're in a pretty bad world. So that's the kind of key counterparty risk, actually, is that you don't have protection on when you need it. But again, that's kind of a level of detail that we can go into at a later date. So just to wrap it up, this is the last main slide I'll talk through. All these things that you do need to consider if you want to adopt, and this is the kind of the mechanics of adopting it. You also kind of need to think about some of the strategic considerations that are to a point wrapped up in there in terms of how much do you protect and what kind of markets do you do it over, where kind of how you want to structure those kink lines, how long you want to have it in for, which manager you want to do it for you. There are 5 or so UK managers who do this and do this well, that you can go and look at. There is exposure through Access Partner Funds who do these kind of techniques, and they've procured a couple of different managers that we can talk about. But like we said, one of the key aspects is getting this monitoring and delegation piece in place. Some of it comes down to putting the right policies there, some triggers. What you tend to do is just tackle this from what is a strategic requirement, put a structure in place, and then you tend to refine some of those policies, because every investor and every committee works in a slightly different way, is willing to delegate decisions to different parties in different ways. So what you tend to do is get comfortable with the overarching strategic need, and that might be, for example, we are closer to the 2022 valuation now than we are backward looking to the 2019 valuation. So that could well be that, we get back to 100% funded, say we've got the valuation on the horizon, we want to just take some of that risk off because we've got back there, because markets have done quite nicely, just to lock in some of that risk that we get a bad event prior to the valuation, and that not being able to be fully smoothed out by the process the actuary goes through that we talked through before. So it's kind of just some of the monitoring and delegation framework is actually kind of set up in the strategic requirements to begin with, and then refined as you work through the first structure. And then what we tend to see clients doing is using this as a kind of a strategic tool that they can put in their portfolio, and they get more and more comfortable with how they go about structuring it, how they go about drawing those kink lines, how they go about monitoring it in kind of future iterations, and get more nuanced in slightly more detail. But it's something we need to consider. So they're the kind of key considerations. We've talked about quite a few of them today, and shared experiences of where we see investors initially go to, but they are some things that you need to decide on. That's kind of it in terms of going through the story, why you might do it and how you do it. I guess the key question is, where do you take it from here? Now, there are good arguments to put these kind of things in place now. There are also the argument that the kind of the vaccine news coming through, the approach by central banks to have a really loose monetary policy, i.e. zero interest rates and pumping money in, that's supportive for markets. The fact that we've lived through the kind of the worst of the market downturn through 2020, and we want to fully participate in any upside, might lead you to think now is not quite the right time. Equally, you could have the converse view that, like I said, the valuation's not a million miles away. We've still got a strong funding position. You might want to do a little bit now, just to kind of go through that initial process and get comfortable with it. So if you want to use it to a greater extent in the future, then you're more comfortable with it rather than going into it cold. I think fundamentally what it'd be useful to get a feel for is this strategically something that would be of interest to have the option to use as part of the portfolio, and then how do we ensure that when we think it is the right time for whatever reason to use this, we're in a position to put something on, and not have to kind of go back to basics and spend a good period of time kind of getting back up to speed, finding a manager to do it, getting our ducks in a row to be able to put something in place. We want to kind of balance those two things out. So again, I'll pause there and take any questions, and certainly listen to any comments.
Thank you, Peter. Again, to the committee, is there any anything you'd like to have a little bit more information on or clarification on? Mark, you're always good for a comment. No?
Is that me you were talking to?
Yeah, sorry, yes, Mark, sorry.
I thought it was someone else. So this is the third time that we have we've been presented with these sort of ideas. So I think we initially kicked off with a similar introduction at least a year ago, I think now. Then we saw River and Mercantile, and I thought that in the office, and I thought with the use of their whizzy piece of kit, I think they managed to sort of sell it quite smoothly. But there's some reservations, I think. Then I think Peter's done a fantastic job again of balancing out the rewards and the risks in the wider sense here. So I suppose in some ways what I would say is I think probably as a committee we do need to move forward at this point, because as I say, this is the third time we've seen it. I will go on record as saying I have reservations about these techniques for open-ended LGPS funds. I believe ultimately the way we should move is to become our own diversified growth funds, which we're doing. And I'm slightly concerned about the confusion of tactical and strategic risk control, which I think is quite complex. I think the best way of mitigating that, particularly if the committee, and I do sense there's one or two members of the committee that actually think this is something we should look at. My thought would be definitely the best way, and certainly what would ease my concerns, is if we really do drill down on this governance structure, so that possibly with a subcommittee or something like that, just because I'm concerned that the officers are put under stress from having to sort of deal with this type of situation. But I do think if the committee have a belief that this is the type of thing that a sort of a long-term investor needs to be involved in, then I think the best way of doing that would be to get a lot of comfort from knowing the fact that it's being managed in such a way that is optimal for the fund, and it doesn't end up essentially being an afterthought in any way. So I think my recommendation would be, I personally, as an independent advisor, do not think this is necessarily the best way to go in terms of risk control. I think there's other ways of doing it. However, I think Peter's explained it extremely well, so I'd be very comfortable that the committee would be able to make a sensible decision. If we were to go with this further, my very strong recommendation would be that the first thing we look to do is put in a clear governance process so we can separate out tactics and strategy and then move forward. And I do quite like Peter's suggestion that it would be possible to have a gradual build up in the process, and only if you become comfortable at each stage would we move on to the next stage. I hope that is clear in my views.
Mr. Chairman, can I say that I actually share that view? I think what we need to look at doing is getting the governance in place and moving things forward in that direction. So that I think that's the most sensible way forward.
You see, this is, I mean, it sort of like, try and put it down in sort of like layman's terms. This is basically an insurance policy.
Yeah, that is a good analogy. It's not, but it's a really good analogy.
I'm going to say it's not, but people think of it that way, yes.
Well, I'm just saying it in layman's terms, so that the public can understand exactly what it is. I understand what you're saying, and it's a bit more complicated than just an insurance policy, and it's so far deep and entrenched in the whole ethos and the governance, as we're saying, the governance of the fund. But as we all know, and I think you're saying how people understand it, is you have to pay for whatever you're going to get. And if you're talking about protection, you're going to have to pay for protection. And then when I get back to saying it's like an insurance policy, is of course, an insurance policy is a complete waste of money unless you need it, unless you actually claim on your policy. You pay it for years and years and years, like your health policy. You could pay for 20 years and not make a claim. And then you think to yourself, well, I paid it for 20 years. What's the point of having this? And then when you stop it, you need it. So I take on board exactly what you're saying, Peter. It's a good presentation again. It's very in depth. And Mark Stevenson, thank you for very much your comments and input as well. And it's all valid information that we've received. As Bill has also said, is that we need to make sure that we've got the governance on this completely and utterly correct and understandable. That's, I think, is gonna go there. So I'm not too sure what else we can say on this, really, apart from which way we're going to decide to go as a committee.
Shall I come in, Mr. Chairman? Yeah. So recommendation 3 actually tries to look at the issues of appropriate implementation and governance. So what we're saying there, we're not saying that you should make a decision to say, yes, let's do equity protection. I don't think it's appropriate to do that in this particular meeting. No. But I do think it would be a good idea to explore further implementation and also deal with the learning points we've taken from our previous experiences, and address the governance structure and decision making structure. So I should put in there it's governance and decision making. Yes, we've had a very interesting 12 months with putting a protection on in another area, having the biggest fall in history, the biggest recovery, and by God, have we spent a lot of time trying to analyse what we should do with that particular product. And it has opened up these issues that we're trying to address before we would put any proposal to actually go ahead for this fund.
I think you're correct in everything you're saying, Paul, and you know, as we discussed yesterday, we're in unprecedented times with the current global situation. It's not just in this country; it's global situation that we've got, and of course, the fund has interest and investments across the globe. It's not just limited to the United Kingdom; it's worldwide. So we have to make sure that we're covered, and our members' funds are protected and will be there for when they require to be paid out their benefits. That's our duty as a committee, as a pensions committee, our duty to ensure that we have the funds available to do so. But notwithstanding that, it's a very good presentation again. So I think unless there's anything else to be said, does anybody else want to add something to it? We'll move to what the recommendations are.
Yeah, I did want to add.
Sorry, but you wanted to speak, didn't you? Sorry.
Yeah. I think the presentation has been very good, and it's built very well on what we learned in the past. We need to learn a bit more, and the governance areas is an area we need to, I think, look at. I'm still not sold on the idea because it all depends on your view of the future and which way it's likely to go, and you hear different things from different people, but one thing you hear consistently at the moment is that we're going to get inflation rises in the next 2 to 3 to 4 years, and that's going to have an impact, and things like that we should be able to gain from as we are currently. So I've yet to be convinced, but I'm quite open to learning more.
That's good points again, Bob. Sorry, I thought I got you confused with Bill. Sorry. That's good points again. And of course, we don't have a crystal ball. We don't know how long this position, the situation, the worldwide situation is going to be. You know, it could be another year, it could be less. We don't know. So we don't know exactly what the outcome or the final outcome is going to be. So if we move to the recommendations, then they're in 3 parts. So it hopefully be an easy decision for the committee. The first part is we note the presentation by Mercer's, which I think we can say has been noted.
Noted, yeah.
Yeah, noted.
Sorry, recommendation 2 is to decide on whether the subcommittee wishes to progress the implementation of an equity protection strategy. So this is the key thing. So if the committee decides that we wish to progress the implementation of it, of a strategy, and then we either agree or not, because if we do agree, then we move to item 3. If we decide not to, then item 3 then becomes redundant, I believe. So the question is, is this committee wish to progress the implementation of an equity protection strategy?
And I think, I guess just a clarity point for me, I presume that is to progress getting some more information to build a proposal rather than agreeing to implement.
No, yes, it does, Peter, because what that does then, if we agree that we wish to progress, it's only to progress it, it's not
That's
actually
right.
a decision whether we accept it or not. It's just to progress the implementation strategy. So whether we have more information, as you said, because then that will move us into item 3.
I think, Chair, before you go on to item 3, we should add a word in that, the possible.
Well, can we decide on item 2 first, Bob, and then I can bring you into item 3? Is that okay?
That's what I'm talking about. Item 2, we should add the word possible.
Okay, then, sorry. Okay, then.
Well, can I suggest to progress the exploration of implementation?
Yes.
Yeah.
Yeah, Bob, are you happy with that wording?
Yeah.
Okay, then.
Yeah.
So,
I'll agree with that.
he wishes to Sorry, Paul, what did you say?
Shall I say that? I'll say it again. So
Yeah.
decide the subcommittee wishes to progress the exploration of the implementation of an equity protection strategy.
Rather than implementation.
Apologies. We should have put that in the recommendations.
No, that's fine. So whether the subcommittee wishes to progress the exploration of an equity protection strategy.
Yes.
If you agree. Yes.
Agreed.
Yeah, agreed.
Thank you very much. So that now does move us on to recommendation 3, which is subject to the recommendation 2, which has been approved. Instruct the head of pensions supported by Mercer to deliver further training and support to the investment subcommittee to help determine the appropriate implementation steps and governance structure for an equity protection strategy.
Have we already done that?
We got there. We got there.
So we're all
more or less. Have we already done that though? More or less now.
Well, we have, but we still have to actually say yes, we agree.
Because there will be further work and further cost implications, and we're just saying to you that, obviously to progress that, we need your approval to do so.
Yeah. So what it is we actually have now to instruct the head of pensions supported to Mercer to progress it. That's what we're doing now.
All right.
Because it's as Paul quite rightly says, it's involving extra time, resources, and obviously costs.
Can I ask as well that it says supported by Mercer? I think I could contribute quite a lot to that, having actually run these structures as a fund manager.
Matt, I would assume that goes without saying that you'll be involved in there in some manner or form.
Brilliant. Thank you, Chairman.
As our independent advisor. Okay, then, so we all agree with that one. So that's fine. Thank you very much for that.
Yep.
And that takes us back to item 9 now, which is in exempt. Paul, if you're still with us,
I am.
I'll read the exempt statement now. Shall I?
Yes, please, and ask the committee to agree it.
Yeah, and then afterwards, then you'll suspend the live feed.
I'll confirm when that's been done. Yeah.
Okay, thank you very much, Paul. So before we move on to item 9, in respect to the following items, the chairman may move or will move the resolution set out below on the ground that if the public were present, it would likely that exempt information, which is information regarded as private for the purposes of the Local Government Act 1972, would be disclosed to them. The committee is requested to resolve that under Section 100A of the Local Government Act 1972, the public be excluded from the meeting for the following items or items of business on the grounds that if the public were present, it would likely be that exempt information in the Part 1 of Schedule 12A to the Act of the descriptions against each item would be disclosed to them. Is the committee in agreement that we move into private session?